All right. Good morning. Good morning. Today is Thursday, August 21st, 2025. Welcome to this month's Capital Markets Update and Outlook call. We are live on our website as well as our various social media pages. If you are here with us live today, or if you are watching in the recording, thank you for taking some time out of your busy schedule to be here with us today. If you are new here, my name is Eric Hagan. I'm a financial advisor. I'm also president of Capital Consulting Group, or CCG. CCG consists of myself, of our Chief Investment Officer Consultant, Tom Fox, who we will hear from in just a couple of minutes. We also have financial advisors Dan Oshman, Rana Grant, and Jeff Halverson, and our client support team, John Knutson and Karen Miller. Together, our goal is to help individual investors make their next financial decision, and the one after that, a good one. One of the ways that we deliver on that commitment is through today's monthly update. Today is an opportunity for each of you to kind of look over our shoulder, get a balanced analysis of what we see, and ultimately to be a more informed investor. We do this in two ways. One, we can help you see your entire financial situation both today as well as every year into the future through our personal wealth planning services. If you'd like to learn more about this, after today's message, I invite you to head on over to clearfinancialfuture.com and watch the short 2-minute video. And second, we help our clients get invested right. Being invested right is distinct to every account that we manage. SmartMix is our personalized portfolio solution, whether you have $25,000 or $25 million. SmartMix is our process for helping you get and stay invested right. And again, after today's message, I invite you to learn more at smartmixportfolios.com. Today, we're going to hear from Tom Fox. Tom will review the positives in the markets, the headwinds, and give us his outlook for the rest of the year and into 2026. Ultimately, again, this is your opportunity to kind of look over our shoulder, get an idea of what we're seeing in the markets and the economy, and what we're watching for. So I encourage you, if you have any questions, to feel free to email me. You can also send us a text. We have a new texting feature that we share our office phone number with. So if you'd like to text us at our office phone number, you are invited to do that. I'll bring those questions to Tom at the end. And then you're also invited to ask your questions in the comments section of the different platforms that you may be watching from. And again, I will bring these questions to Tom at the end of today's message. Tom spends all of his time more behind the scenes, doing market research, due diligence, running different analyses, and really focusing his attention on the economy and the markets. He has almost 40 years experience building investment strategies. He has an impressive long resume. And as always, I'm very excited to have him here with us today for all of you. And again, at the end of today's message, we will have Q&A. So if you are watching live in person with us, or live with us here today, I will bring those questions to him at the end. If you are watching in the recording, please feel free to ask any questions, and I will present them to Tom, and we would love the opportunity to circle back with you at our very first opportunity. So with that, I'm going to bring our theme for 2025 up on the screen. Also going to bring Tom here on the stage. Tom, good morning. Can you hear us?
Yes, I can hear you. Can you hear
Wonderful.
me?
We've got you loud and clear. The
Well, thank
times, they
you.
continue to change, huh?
They are continuing to change, especially with the current administration, what's happening and all the change that's going on there, which we believe in the long term will benefit both the stock market and maybe even the bond market. So I'm excited about the rest of this year, which we'll talk about. I'm also excited about 2026, as a lot of these changes in our economy and government are taking place. I think they're all going to benefit stocks for the long run. But I'm not going into 26 today. We're going to stay within this year, our outlook for 25. And I do expect this year will end well. However, we will go through some bumps as we proceed. And we'll talk a little bit about more of that just in a few seconds. So I always like starting off the wall of worry, Eric, the uncertainties, because there's markets tend to climb the wall of worry, and there's plenty of things to worry about. However, there's the other side, which we'll look at next. So let's go through what's happening right now. Well, right now, valuations are elevated. We're about 22 and a half in that 22 to 23 forward earnings PE ratio, which is a price to earnings is a valuation measure. And if you look historically, we're going to look at a graph on this later, but it is typically we're at a higher end of the valuation. Now, in all my years of doing this, valuation is not a good indicator to determine whether you buy or sell. It typically can be very early or very late. And so it's not a good tactical decision just looking at valuation, but it does give you an overall view of where the whole stock market is. And we are in the upper end in that 22 to 23 forward look. Okay, so the second problem we have is economic slowdown. And there certainly are signs that our economy is starting to slow down. However, we do not see recession. We'll talk more about that in a few minutes, but we don't see a recession emerging, but we could end up slowing down, and we're already seeing signs of that. It's already occurring. We see it in manufacturing, small business sentiment, and also hinting at slower growth in the second half of this year. We expect that. That's one of the reasons that the market's forecasting one or two rate cuts by the Fed because of this economic slowdown. And of course, we're seeing employment, which is holding up, but it's getting weaker. So this is what the Fed has a dual mandate to keep inflation low in their 2% target, but they also have a mandate to keep full employment. So it's the balance between those two. But right now, the economy and employment is slowing down slightly, and we'll see where it ends up by the end of the year. And of course, we always have tariff uncertainty. Of course, we had that disruption earlier in the year when all the tariffs started coming on that brought the market down. And there's still a lot of countries that are impactful to the U.S. that are unsettled. So there's always the fear of raising costs, or which will impact corporate margins, and will inflation come back? Well, all those are a concern. And right now we're kind of in that we're going to find out period. The Fed thought about this month and next month, or maybe the next 2 or 3 months, we're going to really see what the tariff impact is. That's why they haven't lowered rates. But there is a high probability that they're going to lower rates in September. In fact, it's in the 90%. That's the estimate forecast that they will probably do in September. We've been saying September and December, they'll do 2. We think that's still on schedule. But we haven't seen the full impact of tariffs, but we're going to find out real soon. Now, the Fed policy risk, what happens if they think that they don't lower rates? What if we don't get a rate cut in September? Well, that could have a negative impact on the stock market. We could see prices come down from that lack of decision. Well, I guess it's a decision, but if they don't decide to lower rates, or they see inflation, or they see some of the tariff things coming through, and the key is it transitory, or is this a permanent issue? And so that's something they all have to measure out. The other thing we're looking at is consumer debt pressures. We're seeing rising credit card delinquency. I got a chart on this. Higher loan defaults. These are all pointing to maybe some weakness in certain classes within our country in the household balance sheets. So maybe they're not as strong as they were. And so we're going to keep an eye on that. Elevated investor positioning. Right now, we've had, except for, let's say, go back a week. If we go back a week, we are all-time highs. And what's happened is investors are starting to become more and more bullish in their sentiment, and they're getting more and more involved in stocks, which could make markets vulnerable if any bad news would come. And that kind of connects with the valuations that are the PE ratios being elevated. If anything happens that's a negative in news and it's impactful, you can see the market correct very easily. And so we also have, of course, the narrow AI dependence, and that's all about the AI companies. The big tech companies are the big part of everything in terms of earning per share. It's also the beneficiaries. But what happens if some of these AI companies begin to disappoint? What would happen? Well, the market will come down because there are leaders today. We can see a sharp drop. Here's another big one that we're watching is seasonality and volatility. Historically, late summer, fall is turbulent. You look at the August, October period, it's been historically a tough month for the stock market. So there's a seasonality play here. We may be seeing some of that already because we've seen it this last week, some weakness in the market, especially in the tech area. I think it's normal and healthy that the techs are starting to weaken a little bit here. I believe will be short-lived, but this is something you have to be careful of because this is usually a weaker months, but it's also can be highly volatile. So I think we're going to be bumpy, Eric, and we're going to be riding kind of a roller coaster here during these months. However, we're still bullish in the long term. All right, why we should own stocks? Well, the big one is the AI revolution. AI is not just hype, it's taking over. I personally use AI every day in my work. And so I'm using it because it's helping me be more efficient and do a lot more things. But there's so much happening in the build out, CapEx of corporations investing in it, semiconductors, cloud, and enterprise software powering structured growth. And we do see a great future. And we're only at the beginning of this AI revolution. It's going to change everything. And so this is like the internet when it came on many years ago. And now look how big the internet is. Well, the AI revolution is here and it's going to stay. Things will never go back. The companies are going to become more profitable, more productive. In fact, they'll probably not need as many employees. If you've got kids growing up or in college, you better think about what kind of future or profession they go into, because AI is the future and it's going to eliminate in the long term probably a lot of jobs. So you want to make sure you're getting into the right job positions going forward with this radical change. Earnings strength. The earnings have been just blowing out the analysts' expectation. Profits remain resilient. The second quarter showed again, it's not completely over, but the broad bets, most of the companies are beating. It's around 86% are beating the estimates by around 7% on average. That's a big number. So the earnings is now, they expect it to be in single digit. Well, it's coming in at double digit. So what's happening is stocks are performing better than most expected, especially with all the tariff fears that were out there. And of course, it's always good to have the Fed not pointing to raising rates, but actually lowering rates. So easing ahead, that's very good for the stock market. Expect one or two cuts, as we've said. We think there'll be two by the end of this. And so this is positive tailwind for stocks. Then you have Fed easing ahead. Solid consumer spending. Retail sales, amazingly, are holding up. They've been actually quite solid. We're seeing that they remain healthy. We're seeing signals that the consumer, which is the backbone of the GDP, remember, 70% of the GDP is consumer spending. So this is currently solid. We haven't seen it fall back. Many analysts were expecting not only corporate earnings to come down, but they're expecting the retail sales and the consumer to pull back. We have not seen that yet. So that's good for stocks. Healthy balance sheets, corporations, especially in the large cap area, are running with strong cash flow. They got manageable debt, and there's record buyback programs. We're going to look at that chart on that. How many companies are buying their own stock? That's a very bullish sign when companies buy their own stock, and we'll see a chart on that. Market breadth. This is important for sustaining a bull market. We're seeing it this week. Over the last week or 10 days, we've seen a rotation that's coming. Stocks that have underperformed are now starting to perform better. Now, the ones that have been just blowing it out, which is technology, they're taking a breather right now. But this could be healthy in the long term for the overall stock market when stocks that have underachieved start actually performing well. The more stocks that are doing well, the better for the overall stock market. We think it's healthy. And then historical patterns. When you see 18.9%, we're going to look at a chart on this, was followed by a 30% rebound. That historically, when you get that kind of rebound from a correction, it tends to keep going. It doesn't just end, but it may go on for years. So right now, there's momentum to the upside, and we think that's going to continue, although we're kind of in that seasonality. So we may see some bumps in the road, some pullbacks, even perhaps another correction, which we think is all healthy for the long-term stock market. Global capital flows. Many foreigners are starting to buy U.S. stocks. Even the U.S. companies or investment money managers that were investing in Europe and overseas, which did very well, they're shifting their portfolios back to the U.S. right now. So there's a big flow of money coming from foreigners, and even investment money managers in the U.S. are starting to come back to the United States. And I think overall, the view is that what's happening in our administration is going to benefit stocks in the long run. So we'll keep an eye on that, but that's a good sign. It's a bullish sign. That's why we own stocks today. All right, reasons stocks keep making new highs. And this is sort of through last week. But what you can see is that when the tariffs came on and we hit April lows, the market intraday dropped 18.9%. That's a big drop. But look how much it recovered and how quickly. This was the fifth fastest drop in history, and this was the fastest rise from a drop in history. So we have a 30% recovery, which gives us a year-to-date around 9%. You can see the dotted line. That's when we actually broke into new highs. And we had, if you remember, we had a lot of charts in our previous months that looked at how much cash was on the sidelines, $7 trillion in money market funds. Well, when we hit the new highs, that money started rolling in. That's one of the reasons we've had such a large rally, is that people are FOMO, fear of missing out. And we had a chart on, I think, on that last week, or we talked about that, or last month, excuse me. So right now, this is looking very good, kind of all in the historic range, but we're at new highs. Why is this happening? Earnings and margins are resilient. We talked about the earnings. You can see that corporate America delivers in the second quarter. Then the estimate is 11.2 once all the stocks come in. They were expecting around 9. So this is beating estimates. And we went from single digit to actual reality of double digit. You can see that the forecasts for earnings overall and the growth rate is rising. And this is a good sign. And this means what really drives corporate prices at the bottom line is earnings, corporate earnings. And right now, companies are working out the tariffs. They're working out how to deliver bottom line earnings to their companies. And you can see I circled the first quarter and second quarter. You can see the Magnificent Seven, how much of the earnings are coming from the Mag 7, which is the big tech companies. You can see it's still very high. About now, the expectation that's going to come down because you're going from a higher number when you go year over year or quarter over quarter. That number, when it's already high, you can't really continue the growth rate that they've had in the past. But you can see it's still going to be going forward a significant dominant earnings force as we move forward. But a lot of the reason that the overall S&P 500 has done so well is because of the big techs, and we don't see that going away. Now, here's the corporate margins. So margins are important. How much are they making? When you take out when you look at the revenues minus the expenses and what are they making, you can see that the estimates are rising. You can see the first and second quarter is strong and expected to even go higher. Now, AI may be a part of this because you're getting more productivity. You're getting more efficient in companies. So I think this number may be underestimating what will happen. But this is all good news for corporate profits, all good news for companies becoming more and more profitable as we go forward. Now, this is the 25. This is a different view. And 26, we're looking at the consensus S&P 500 and the earnings per share for 25 and for 26. And there's a little arrows on the right side, Eric, if you can see those. What's happened is that analysts are raising their estimates. That's a good sign. So even in 26, we're expecting better earnings as we go forward. That's one of the reasons we're bullish, not only to the end of this year, again, with bumps in the road in the seasonality play, but next year we're very bullish as well. Stock breadth expanding. I talked about how important it is for other companies to begin to participate in performance. And we actually have seen that a lot in the last week or 10 days. Part of that has to do with the expectation of lower rates. Value stocks start to perform well if interest rates are dropped. Also small caps. So we're starting to see some breadth where more and more companies are beginning to do well. And this is how many companies percent are above their 50-day moving average. And this is all healthy for a bull market going forward. We can see this. Here's the dates 8/8 through 8/14. But you can see that the breadths shifted with the expectation for these lowering of the rates by the Fed in September. You can see small caps, which have been big underperformers, actually had a good week. And you can see that even the S&P equal weight outperformed the S&P capitalization weighted, and value did well too. Mag 7 still positive, but you can see that breadth kind of spread out over this last week. A lot of this has to do with the expectation of interest rates coming down. We do expect tech and big tech to do well, however, to the end of the year. And I think there'll be, if we can get more breadth happening in some of these other areas, and I also think it will set up for more gains in technology towards the end of the year. Corporate buybacks. And this is really a supply demand, because if we have so many people buying stocks and there's less stock available, that's automatically actually increasing stock prices. So companies buying back stock, there's been a lot of studies on corporate buybacks. When you have companies buying their own stocks, they think the market is really, it's a good time to get into their own stock, but also they believe that going forward, the stock should do well. And so this is a great characteristic that can happen in the stock market. But if you look, you can see the growth, how many more companies are buying their own stocks back. This is very bullish for stocks in the long run. Here's a few companies. These were the largest buybacks. Apple, and you've seen Apple turn around and starting to perform now. Some of this has to do with their buybacks. You got Google, you've got JP Morgan, some of the Goldman Sachs. A lot of these companies have actually done well as they keep buying their stocks. And sometimes they'll buy their stock because they think their stock is undervalued. So these are some of the bigger plays this year in 25. So we expect more of this to come. And this, again, is good for stocks in the long run. There's been high expectations. We've talked about for stocks, we've talked about the PE ratio, and you can see where we are in the multiples, somewhere around that 22 and a half, 20 or 21 and a half to 22, somewhere 22 and a half. There it is. Thanks, Eric. So we have somewhere around that, but you can see that the stock market's been higher because this goes back to 2000. That was the tech bubble. You can point to that big bump up there. We're still below that. Now, remember, this is a lot different. In the technology rally today is different than it was back then because there wasn't the revenues and there wasn't the profits that we're seeing. Today, it's justifiable for these tech companies, and that's impacting the S&P 500, to be this high because they do have revenues and they do have earnings and they're healthy. They have cash. One of the reasons we had the big tech crash that brought the stock market down was because there just wasn't the revenue growth. There wasn't the earnings growth that we have today. And again, we're in a revolution. This is going to be driven by AI, and all the companies that are adopting AI for their business to make it more efficient, more productive, is going to really help stocks in the long run. So the whole AI, which I, again, am using on a regular basis, it's helping my business. So Eric, I don't know if you're using it. Are you?
We are, absolutely. Yeah, we keep getting introduced to new tools. Just introduced one that really helps us understand our clients better and helps organize their goals, objectives, and I mean it's phenomenal what we're seeing and what we're getting some sneak peeks on of what's ahead.
That's
definitely.
great. Yep. And so every business, AI tools are being developed, which will help investment managers, registered investment advisors, people like me, and every manufacturers, you name it, are all going to benefit from this AI revolution. And again, we're at the forefront because now the AI is there, and now they got to just figure out how it applies to each company and how can I make my company more efficient. So we're really going to see, I think, over the next several years, tremendous growth in companies as they become more efficient. All right, well, let's shift here. Inflation was expected to rise a lot because of the tariffs. Well, guess what's happened? It hasn't happened. Hasn't been as bad as expected. We didn't forecast that it was going to go up a lot because of the tariffs. We were actually on the right side of this. We've been in the stock market, so we participated. We expected a slight increase. Well, that's what we've been getting. And of course, the Fed is now probably going to restart the rate cuts. Well, that again is a tailwind for stocks as well. And you can see here where the inflation is, both in core. And so you can see the headline CPI and the core CPI. It's just been kind of going sideways. Of course, the Fed has a 2% goal. We'll see if they get there. But right now, because of the tariff, maybe tariffs finally entering the market, we may see a little bump up, but it's nowhere near what most feared. That's one of the reasons people were out of the stock market or not fully invested in the stock market because of this fear. Well, it has not been realized. Now we're going to really find out more information over the next month or two, whether or not this is going to bump up or if it's just minorly bumped up. But we think in the long run, with all the efficiencies this is going to come down to the 2% goal that the Fed is looking for. Okay, there is slowing economy, sentiment softening. We're going to look at this. So this is summer hiring. You can see it's been on a downtrend, which means there is a little weakness in the U.S. employment numbers, and so we're watching this. And again, this is probably the main reason that the Fed is going to lower rates, because they want to keep the employment strong, or if it's weakening, they want to turn that around by lowering rates. So I do think that high probability of September and maybe even a December cut's going to come to pass. But you can see there is some weakness. So this is making the September rate cut more probable. The ISM composite, which is shows a lot of different, it's a mixture of the health of our economy from the wholesale point of view, from the corporate point of view, their inventories, the purchases, the prices. It looks at a lot of different things, and it goes into the ISM composite. And if it's above 50, where that means the economy is still in expansion, and you can see it's above 50, so we haven't gone into a potential recession coming. However, it is on the weaker side and from what it's been. And so this could be an indication that things are slowing, and from the corporate level, that there's some maybe some stumbling coming up in the future. But we're keeping an eye on this. But right now, it's still in expansion territory, but it is softening. This is, again, an overview of the general health of our economy. Now, here's the delinquencies. We talked about this, consumer weakness. It's 90 days where balances, there's issues with delinquencies. You can see it's rising. Recently, it's going up. Now, it's kind of tailing off right now if you look at the top area, but we're keeping our eyes on this. Now, this was primarily in the subprime, but it is starting to creep up into higher income levels. So you got to keep an eye on this, because, of course, again, it impacts the consumer spending, which is 70% of our GDP. And so we're keeping an eye on that. But there's some weakness, but nothing that would say that we're heading into a recession. Let's look at that chart. So this is from a corporate view on earnings calls of companies. You can see what's the number of times that the corporate on the earnings call that either the CFO or the CEO talked about recession. And you can see how high it was in the April to May, but look where it is in the July, August. It's very low. So we're seeing less talk about an upcoming recession. The fear was because of the tariffs, of course, in April and May, that they're going to impact everything and it's going to bring us into a potential recession. That has not been realized. And you can see how many times it's mentioned. It's dropped significantly. So this is a good picture that companies now are not seeing a recession, because the recession talk has been minimized. So here's our updated outlook. If maybe you were on with us last month, guess what? No changes. So some of these are actually taking place. Economy cools, then rebound. We expect that later in the year. We do expect a cooling during this month, the next few months, but we think it reaccelerates and into 26. Stock market volatility will remain high. We've seen that, and it's actually, I believe, going to pick up during the seasonality where usually things get a little rough. So there, but also we talked about volatility to the upside. Well, we have certainly seen that in that 30% rise from the April lows. Technology side leadership continues, especially in A. Now we're starting this last week to see some movement towards the other areas of the stock market. But we do believe before the year is out that it will come back to AI and tech will begin to do well again. And of course, inflation rises. We see just slightly temporarily impacted by tariffs, and then it retreats overall in the long term. I expect that to start taking place, especially as we approach the year end. And of course, the Fed starts cutting rates in September. We've had this on here, I think, Eric, the September, December, and right now the forecast, investment forecast, is over a 90% probability for September. So we'll see what happens. But right now, looks like this is going to come to pass. Now, the bond rally hasn't happened, and that's because the Fed is held. But once they start lowering rates, then we could see a bond rally. Of course, the intermediate treasuries are down from their highs, and it's been kind of bouncing around. But I think once they actually, the interest rate cuts are realized, and of course the narrative that Paul delivers in his speech will determine what will happen, and we could see a bond rally. I think it happens between now and the end of the year, but it doesn't. If bonds rally, because you could have many times when stocks and bonds are rallying. So I think that actually that's my forecast, that by the end of the year, rates will be lower, so bonds will rally. But I think stocks rally much more than bonds. So becoming more bullish. You can remember that we've got higher investments from foreign and CapEx, and the economy turns up. We're starting to see that. And again, we've been bumping up our year end, and we remember we're up 9% for the year. I think we've dropped maybe a little bit from there, maybe to 8%, but we still think it's going to be at 10 to 20% by December 31st this year. So we've become more and more bullish. And of course, we always like to throw these in. These are the wild cards: geopolitical event that rocks the market, assassination. There's already been 2 attempts on Trump. Hopefully that never happens. And of course, Ukraine, Russia, which is in all the cable news right now to see what happens there. Israel, Iran has settled down, but it doesn't mean that something couldn't come up again. And of course, there are proxies. And of course, you always have China and Taiwan. Now, President Xi of China did say to Trump that he will not invade Taiwan while he's in a president. I wouldn't believe him, but that could happen. So that was a good thing that just happened recently, Eric. Anyway, to summarize, we are bullish. We think there'll be some rough spots in this season, this weakness, August through October, but we do think the stock market will end higher than where it is today.
Excellent. Thank you, Tom. Definitely no shortage of thorough analysis. So really appreciate the depth that you bring to this conversation and this message for everybody. With that, would love to open up to any questions. So I have my email, I have our text feature open here. If you have a question, feel free to shoot me an email or send us a text, a new texting number for everybody. You can text us directly at our office phone number. You can see it kind of in the small print there at the bottom of the screen, but it's 952-540-0153. If you are with us here live today, I do see a good number of you out there, so thank you for joining us. If you want to post a question in the comments section below, you're welcome to do that. I do get those. I'd love to bring it to Tom. Friendly reminder for anybody watching in the recording, feel free to reach out. I will have the recording on the website this afternoon. You'll also have a button where you can download the cheat sheet. So if you want the 2-page summary of Tom's message, or if you want to ask a question more privately, you're able to do that right on there as well. While we wait and see if any questions do come in, Tom, I don't have any right now. Friendly reminder as well, start my week off every Monday morning with kind of a 3 to 5 minute update, overview of what's going on in the markets and anything going on around the office, things that you might want to be paying attention to. And then send out an email at 2 o'clock in the afternoon, that's Central Time, linking back to that video. So if you can't join me live Monday mornings at 9, a link back to that video. Again, just a short touching base update on what's going on in the market. So love to have you join me on that. And then for those of you joining us tonight, we're really looking forward to it. We've got our annual Capital Cruise Client Appreciation Dinner. I think we've got almost a full boat. So if you did not RSVP and want to join us, we'd love to have you. Definitely call or text right away here. Love to have you on board. I think we had 3 people that had to call in sick yesterday. So we've got a few spots. So love to have you. I think we're at around 120 people or so right now. So very full boat and really looking forward to it. Be departing out of Mound on Lake Minnetonka here at 6 p.m. sharp. So to all of you joining us, we really look forward to celebrating you. We are in the business of serving you, and we just want to celebrate that and just really appreciate your friendship, your partnership, and your business, of course. So really looking forward to a fun evening tonight. So with that, I will say thank you to everybody again. Check my different spots here real quick. Tom, if you have any closing,
Sure.
I don't have
My wife
no
and I,
questions.
Marie, will be on the boat tonight. So if you do want to talk or have questions, I'll be there. So
Pick
if
his
you want
brain, you
to talk
guys.
a little bit,
Pick his
I'll be
brain.
on the boat. You can come
There's a
seek
lot
me
in there to
out. We're
pick.
usually on the second floor. It's either outside, inside, probably outside. We'll see. So we'll be on the boat and look forward to seeing you tonight.
Both inside and outside is going to be fantastic tonight. We've got just perfect weather for a cruise out on Lake Minnetonka. If you remember last year, we had that storm front come through, and it was pretty rough there for about a half an hour, and kind of kept some people home. So definitely looking forward to some much better weather here tonight. So really looking forward to it. Can't wait to spend some time with everybody. Come with your questions. If you have anything for Tom, pick his brain. He's always very willing to share. So we look forward to that. Tom, I don't see any questions in here, so I will go ahead and wrap us up. But thank you again very much, Tom. I appreciate
Thank
you.
you, Eric.
And appreciate everybody spending some time here with us. So with that, that concludes this month's Capital Markets Update and Outlook Call for the month of August 2025. Bye, everybody.